If you're freelancing in 2026, your health insurance just got more expensive. The enhanced premium tax credits that capped marketplace premiums at 8.5% of income expired on December 31st, 2025. Congress let them lapse. That means a 45-year-old freelancer earning $75,000, who paid around $390 a month last year, is looking at closer to $560 a month this year for the same silver plan, according to KFF's 2026 projections. That's roughly $2,000 more out of your pocket. But here's the part most freelancers miss. There's a deduction sitting in the tax code that can wipe out a huge chunk of that increase. And almost no one uses it correctly. So here's what we're doing in the next 13 minutes. I'll walk you through your 4 real options on the marketplace this year, how to pair a high-deductible plan with an HSA to triple dip on tax savings, and the self-employed health insurance deduction that the IRS says fewer than half of eligible filers claim. Let's get into it. Start with the marketplace, because for most freelancers this is still the default. Healthcare. Gov open enrollment for 2026 coverage runs from November 1st, 2025 through January 15th, 2026 in most states. Miss that window and you're locked out unless you have a qualifying life event. CMS reported that 24.3 million Americans enrolled in marketplace plans for 2025, and a record share of those were self-employed or gig workers. Here's the thing nobody tells you. The marketplace isn't one product. It's 4 metal tiers: bronze, silver, gold, and platinum, and the right choice depends entirely on how much healthcare you actually use. My take is most freelancers default to silver because it sounds balanced, and that's the wrong reflex. Here's how I think about it. If you're healthy, rarely see a doctor, and you have an emergency fund, go bronze. Premiums are the lowest, deductibles are high, but you're buying catastrophic protection and tax-advantaged HSA access. If you have a chronic condition, take regular medication, or you're planning a pregnancy, gold or platinum almost always wins on total annual cost once you add premiums and out-of-pocket spending together. Silver only makes sense in one specific case: if your income qualifies you for cost-sharing reductions, which are still available in 2026 for households under 250% of the federal poverty level. That's roughly $39,000 for a single filer. Below that threshold, silver gets you reduced deductibles and copays that bronze and gold do not. Above it, silver is usually the worst value on the exchange. Your tax bracket and your expected medical usage drive this decision, not the color of the plan. Now let's talk about the premium tax credit, because even with the enhanced version gone, the original ACA subsidy is still there. Households between 100% and 400% of the federal poverty level still qualify. For 2026, that's an income range of roughly $15,650 to $62,600 for a single filer, and $32,150 to $128,600 for a family of 4. If you're under that ceiling, you'll get a subsidy. If you're over it by even $1, you get nothing. This is the cliff that came back. And here's where freelancers have an advantage W-2 workers don't. You control your taxable income. Contributing to a SCPIRA or solo 401(k) lowers your AGI. Lowering your AGI can pull you back under the subsidy cliff. I've seen freelancers save $4,000 in premiums by making a $5,000 retirement contribution. That's the kind of math you should be running in December, not April. One more marketplace point most people miss. If you have a spouse with employer coverage, you usually can't get a subsidy if their plan is considered affordable. But the IRS fixed the so-called family glitch in 2023, and that fix is still in effect for 2026. Affordability is now measured against the cost of family coverage, not just the employee-only premium. If you've been told in past years that your spouse's job disqualified your family, run the numbers again this fall. A lot of freelance households became newly eligible and don't know it. The next piece is the HSA, and this is where the real wealth building happens for self-employed people. A health savings account is only available if you're enrolled in a qualified high-deductible health plan. For 2026, the IRS defines that as a plan with a deductible of at least $1,700 for self-only coverage or $3,400 for family coverage, and an out-of-pocket maximum no higher than $8,500 self-only or $17,000 family. If your plan qualifies, you can contribute up to $4,400 if you're single or $8,750 for family coverage in 2026, according to the IRS revenue procedure released last spring. If you're 55 or older, you get an extra $1,000 catch-up. Here's why I call the HSA the best retirement account nobody talks about. It's the only account in the tax code with a true triple tax advantage. Contributions are deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. Compare that to a Roth IRA, which only gives you two of those three. The right move for any freelancer on a high-deductible plan is to max the HSA before you max anything else, except a 401k employer match, and you don't have one of those, so the HSA is your first dollar. But here's the trick almost no one executes. Don't spend the HSA. Pay your medical bills out of pocket, keep the receipts, and let the HSA invest in low-cost index funds inside the account. Fidelity offers HSAs with zero account fees and full brokerage access. You can reimburse yourself for those receipts decades later, tax-free, after the money has compounded. A 35-year-old freelancer contributing $4,400 a year and earning a 7% real return would have about $416,000 in that HSA by age 65. That's tax-free medical money in retirement when you'll need it most. Fidelity's 2025 retiree healthcare estimate says a 65-year-old couple retiring today will need $172,500 in after-tax dollars just for medical costs. The HSA is how you fund that without touching your IRA. There's one wrinkle on HSAs that catches freelancers off guard. The moment you enroll in Medicare, even just Part A, you can no longer contribute. Part A enrollment is automatic for many people who file for Social Security at 65. If you're still freelancing past 65 and want to keep funding your HSA, you need to delay both Social Security and Medicare enrollment. That decision has knock-on effects on your retirement income, so don't make it casually. Your overall financial picture decides this, not the HSA alone. Now here's the deduction that almost nobody claims correctly. It's the self-employed health insurance deduction, and it lives on Schedule 1 of your 1040. If you're self-employed and you're not eligible for an employer-subsidized health plan through your spouse, you can deduct 100% of your health, dental, and qualified long-term care premiums, not 50%. Not subject to the 7.5% AGI threshold that hits W-2 workers on Schedule A 100%, dollar for dollar, above the line. The IRS statistics of income data shows that of the roughly 27 million sole proprietors filing Schedule C in the most recent published year, fewer than half claimed this deduction. That's billions of dollars freelancers leave on the table every year. Why? Because most people enter their premiums through healthcare, get a subsidy applied, and assume that's the end of it. It isn't. The portion of the premium you actually paid out of pocket, after any advance premium tax credit, is still deductible. Let me walk you through real numbers so this lands. Say you're a single freelancer in 2026 with $80,000 of net self-employment income. Your Marketplace Silver plan costs $7,200 a year. You don't qualify for a subsidy because you're over the 400% poverty line. Without the deduction, you'd pay federal income tax on the full $80,000 minus the standard deduction. With the self-employed health insurance deduction, you knock $7,200 off your AGI. At the 22% marginal federal bracket, that's $1,584 back. Add roughly 5% in state tax savings, and you're at about $1,944. That's real money. And it doesn't reduce your self-employment tax. That's a common misconception. but it absolutely reduces your income tax and your AGI for every other phase-out that matters. Here's the limitation almost everyone gets wrong. The deduction can't exceed your net self-employment earnings. If you had a slow year and only netted $4,000 on Schedule C but paid $7,200 in premiums, your deduction is capped at $4,000. The remainder doesn't carry forward. It just disappears. So if you're having a low-income year, this is another reason to be careful about how aggressively you deduct other business expenses. Over-deducting can erase your ability to claim health premiums. One more wrinkle: if you operate as an S-corporation, the rules are different and stricter. The corporation has to pay the premiums and include them as wages on your W-2. Then you deduct them on your personal return. Mess up the W-2 reporting and the IRS can disallow the deduction entirely. If you're an S-Corp owner, talk to a tax pro before December 31st. This is one of the most litigated issues for small S-Corp, and it's worth getting right. What about the alternatives if the marketplace just feels too expensive? Health sharing ministries get pitched constantly to freelancers. The monthly cost looks attractive, often $200 to $400 for a family, but these are not insurance. They're not regulated by state insurance commissioners. They can decline to share your medical bills for almost any reason, and pre-existing conditions are typically excluded. The Commonwealth Fund's 2024 study found that members of health sharing ministries reported unpaid medical bills at more than twice the rate of ACA enrollees. My take is clear. Don't use one as your primary coverage unless you've stress-tested what happens if you get cancer next year. The math usually doesn't survive that test. Short-term limited duration plans are another trap. They're cheap because they don't cover pre-existing conditions, mental health, maternity, or prescription drugs in most states. A federal rule finalized in 2024 capped these plans at 4 months total, including renewals. Use them only as a bridge between coverage, not as a long-term solution. A better path for some freelancers is joining a professional association that offers group coverage. Freelancers Union, the Authors Guild, and several state-level chambers of commerce sponsor group plans that can beat marketplace pricing if you're over the subsidy cliff. These aren't available in every state and the underwriting varies, so your geography and your specialty matter here. Before I wrap the framing for all of this, I help freelancers figure out the money side of going solo, and the pattern I see over and over is people optimizing the wrong variable. They shop for the cheapest premium. The right variable to optimize is total annual healthcare cost, premium plus expected out-of-pocket, plus the tax value of the deduction and HSA contributions. Run that math for each plan you're considering before you click Enroll. A bronze plan plus a maxed HSA plus the self-employed health insurance deduction will beat a silver plan with no HSA for most healthy freelancers earning over the subsidy cliff. That's the playbook. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this was useful, hit subscribe. I publish a new freelancer finance breakdown every week, and the algorithm only shows you the next one if you tell it to. If there's a specific freelance tax or insurance question you want me to dig into, drop it in the comments and I'll work it into an upcoming video. And if you're shopping HSAs this open enrollment, Fidelity's HSA is the one I personally use because of the zero fees and the brokerage access, link in the description. This video may contain affiliate links. I only recommend tools I use personally. See you in the next one.